In this video, I explain closing journal entries. Closing entries are prepared only at the end of the year to get ready for the next year. When preparing closing journal entries, we must consider the differences between temporary accounts, which are our revenues, expenses, and dividends, and permanent accounts, which are the balance sheet accounts of assets, liabilities, common stock, and retained earnings. Temporary accounts start with a zero balance at the beginning of each year. This requires closing entries to reset them at the end of the year. In contrast, the balance of permanent accounts carries forward to the next year, meaning the ending balance of year 1 becomes the beginning balance in year 2. For this reason, we are required to use closing journal entries to close out the temporary accounts into the permanent ones. We use a new account called Income Summary to help us with that process. The steps for closing temporary accounts are as follows. First, we close the revenues. Next, we close expenses. Then Income Summary. And lastly, we close out the dividends. Using the adjusted trial balance, we will first identify the temporary accounts that need to be closed. Our first entry is to close revenues, so we will do a debit to service revenue and a credit to Income Summary. Since revenue is a credit normal balance, the debit effectively clears out the account back to a zero balance and puts all the revenue amounts into the Income Summary account. The second entry is to remove all the expenses by crediting each expense account and debiting Income Summary for the total of the expenses. After this journal entry, the balance in Income Summary reflects the net income of the company. Next, we have to close Income Summary into retained earnings. The Income Summary account currently has a balance of $7,250. So to close that account, we need to debit Income Summary and credit retained earnings. This completes the process of increasing retained earnings by the amount of net income for the year. The last step is to close the dividends directly into retained earnings with a debit to retained earnings and a credit to dividends. Now the retained earnings account has a new ending balance for the year. Our post-closing trial balance shows our new balance in retained earnings and only the permanent accounts. There are no temporary accounts in a post-closing trial balance because they all have a zero balance. We have now successfully closed and are ready for the next year.
Created using Powtoon.